Hi, this is Rob with Market Traders Journal. Thanks for joining me. I wanted to go over a concept that I work with quite a bit as a trader, and it really has to do with looking at the way ranges are manifesting. And so what I did was I coded, used mostly for my research platform TradeStation because I have flexibility of data and it's easy for me to code. I'm not as good of a C-sharp programmer, so what I have done is I've coded up an analysis of the ranges so that you can see them more clearly on this region of the chart. And essentially what this is doing is it's analyzing the difference between the range over time. And so when the range contracts, you will see it come down into a region here, and as it expands, as you get big bars, it'll come down into here. And so what it's doing is it's looking at the averaging of this expansion and contraction just to slow it down a little bit rather than looking at individual bars. It kind of makes it so you're looking at chunks of data, but you're really looking at the bars themselves at the same time. But what we generally see in these markets, and I've talked about this for a long time, that the markets are anti-persistent is a term that I use. And so what we see is as the market expands or goes down into a region of previous low, you'll find buyers in there. And as you take out even this low, you'll extend past it a little bit, and then you'll come up into this region again, and when you take out this high, you will come back down because you will find sellers up in this region. So as you get over into here, it'll come back down. And so what you see is this constant alternation back and forth all day, that you are alternating between areas of previous trading and between the ranges. Now it's easy to see when you look at a market the cycling. As a matter of fact, that's the first thing that you would note on the chart, is that it zigs and zags up and down. And I often talk about the market finding lower highs and lows, as you would find right here. There's a downtrend, a low, a lower high, and then a lower low, so you officially have a downtrend in this region. And so as a trend trader, you might expect some continuation there. And then you will also, as you start upward, you'll start to establish an uptrend. But this is not always an entirely clear picture. But the type of cycling that I'm talking about for this purpose is not the expansion or the rolling of the pricing, but the expansion and contraction of the range. You will note over in here we have an expansion of range. We have an expansion of range right in here, and we have an expansion of range right in here. The bars get big, see? We have an expansion of range right in here. We have another expansion of range right here where the bars get big. Now you will notice, and I've talked about this before and in various articles on the blog, that we would cover most of the day's range with really just a few large bars. And the ratio is pretty staggering if you do that analysis. You could look through the Market Traders Journal blog and find the article having to do with that. But for our purposes here today, what we want to do is we want to see this expanding and contracting of range. And so I wrote this indicator for that purpose. Now what you will see is as the range contracts, we will expect the market to expand. And as it expands, we will expect it to contract. And this can be a very important principle in trading, because you don't always want to be trading into volatility. You want to be trading coming out of a quiescent period or zone, and you can manage your risk this way. There are a lot of things that you can actually do with this. But if you were a scalper, I have a 5-minute chart here, but if you were a short-term trader and you saw this low volatility period occurring right in here, you would expect the market to break out from that region, and that's exactly what it does. It goes a little higher. And you're looking to something to the tune of a couple points here, which if you trade any size in the Russell is a substantial amount of money. You see it again here. You come down into a low volatility range and then zone, and then you expand again. And then you see this cycle expansion here. And then you see it again, you have low volatility again, you have this clustering of bars, and then it breaks higher. On this particular one, we didn't catch a low volatility before we got into that, and I call this a failure. What we have is a zone of pricing here where we broke out to the upside, and then we broke back through that whole zone. And so this is just part of trading, is not only identifying good trading opportunities as they set up in one direction, breaking out higher, but also where they fail as well. Another zone was right here where we had some smaller bars, and then we expand from there, and finally till we get up into here. And then as soon as we see this high volatility occurring, we expect to attract sellers, particularly where it's occurring at a previous swing point, and that's exactly what we did. And then we had this small retest that was also associated with low volatility, a retest, and then the failure. And then that was the whole day. That was yesterday. Let's go ahead and see what we have today, because we have a few more minutes on this video. We have a low volatility region right here, and then break lower. We didn't quite make it into a full low volatility here, but we had a small bar in here and a small bar here with a big bar in between. And then we've broken higher, coming up into yesterday's close region. I would probably expect, now that we have this expanded range and we came to the close, to see this selling off a little bit. Let's go look at another full day, because as I said, we do have a few more minutes. And here we get a low volatility area right in here, and we get a break from there, a retest higher, failure to reach this area, and then we get a range expansion down into here. We have a low volatility region right here, and we break from that higher, getting a high volatility area here. We break down into this area down in here where we get a clustering of low volatility. This is midday lunch period. This is Pacific time where I live. And then we get a range expansion up into here. Then we get a range contraction and another range expansion trying for the retest and failure. We get a range contraction right in here, and then we break lower, expanding in volatility. We find another one here, and of course by then it's the end of the day and nobody's really interested too much. Anyways, I wanted to share this concept with you because it's a very important part of trading, particularly when it comes to managing risk, because if you can trade in the low volatility zones or coming out of the high volatility zones, you can manage your exposure in the market effectively when you were doing that. And so I just thought I'd share this with you. You don't need any fancy tools to do this. You can see it occurring on your chart. You can see you have a low volatility region followed by a high volatility region, a low volatility high followed by high, etc., etc. So I don't necessarily condone having a chart like this on your screen, and what I do try to encourage people to do is to become intuitive in the way they trade. And so you look at the chart and you see not only the higher and lower cycling, the testing of previous regions, but you're also seeing the expansion and the contraction of the range. And when you put those three things together as an intraday trader, it's very powerful for you. So that's what I have and what I want to share with you today. Thank you for joining me, and thanks for supporting the blog.